Good afternoon, everyone. I'm Ritika Gupta. I'm a reporter at Bloomberg Television, and I'm very excited for our Oceanside discussion today, Building Tomorrow's Tech Today, Perspectives from the Forefront. And who better to give their perspective than Marc Ganzi? He's the CEO of DigitalBridge. This is an infrastructure firm. They manage over $75 billion in assets, includes data centers, cell towers, and fiber networks. And the company stock, it's up around 40% on a year-to-date basis. And a lot of that gain is partly tied, as you can guess, to this big AI hype. So I actually want to start there, Marc, and get your perspective with all this hype. How much I was wondering if you can kind of quantify in percentage terms that demand for AI at DigitalBridge.
Well, look, I try to just distinguish between the hype and what's reality. And I think that there's a lot of great ideas chasing AI right now. Our thematic and how we're chasing it is, think of us as really as sort of the dumb plumber, right? Someone's got to build the plumbing and the infrastructure to ultimately make it work. And the way we frame it for investors is we're going to play sort of a 4-quarter football game in building artificial intelligence infrastructure. We're very early in that first quarter. We're probably in the 3rd or 4th minute of the game. And right now we're super focused on building, high density, high power compute data centers that can handle the amount of parameters that are ultimately in language models today. So if you go back 10 years ago at the onset of really public cloud in 2013, most language models were measured in millions of parameters. Today, language models in big AI, like for example with ChatGPT, 50 billion parameters are ultimately those language models. And so exponentially, data is growing faster and faster and faster. And so we don't measure data center compute in kilowatts or megawatts. We're now measuring it in gigawatts of total power. And this really starts about a 10-year build for artificial intelligence infrastructure. It took us 10 years to build the public cloud. That was at a cost of about $3.6 trillion. We're going to spend $5 to $6 trillion building artificial intelligence infrastructure, which will be one part data center, certainly a lot of fiber connectivity, and then certainly mobile infrastructure to make AI work at the edge. And to be clear, the edge is your handsets or your home or your car. There's millions of industrial use cases where AI will be ultimately enabled and proliferated. So this is a big journey for us.
And Marc, I think I read an article and I think you quantified it as roughly about 20% AI demand from DigitalBridge. Is that roughly correct?
Yeah. So to contextualize that, we're turning on approximately about 700 megawatts of compute power every year. We think that's going to grow. We think ultimately we'll deliver about 1.5 to 1.75 gigawatts of new compute power. But today, AI only represents 20% of that demand. So the other 80% is still coming, believe it or not, from the cloud. In terms of how we're building public cloud, building private cloud, the cloud is still growing in terms of the infrastructure that's needed to support cloud applications, content, and everything that enables our lives to work today. And so again, I always bring it back. AI is early. We're in the early formative phases of building that infrastructure. And it's a long build. It's not a short, immediate 2 to 3 year build. It's going to take a lot of time, which is why we're so busy today.
And of course, you just had earnings out. So how are you kind of seeing this AI demand? How is it impacting your fundraising?
Well, look, fundraising has been good. I mean, investors are excited about infrastructure. Most asset allocators today are underweight infrastructure. So if you look across big sovereign wealth funds and big pension systems, which is where we raise a lot of our capital, typically those sources of capital are underallocated to about 2 to 3% infrastructure. Mm-hmm. Asset allocators really want to get to about 5% in infrastructure and ultimately 5% renewable energy, which most people are about 1 to 2%. So I just finished traveling for 3 weeks around the world, seeing about 90 investors. And the same theme came up over and over again, which is we want more exposure to digital infrastructure and we want more exposure to renewable energy. And I think for us, that intersection of renewable energy and building data infrastructure will be keeping us quite busy. We did have a good quarter. We've raised over 11 billion of debt capital this year. We've raised over just a little over 5.3 billion of equity across our strategies, and investors continue to give us capital in an environment that is certainly, I would characterize as being uncertain. And people are sort of waiting to see what's going to happen. But at least for our asset class, we're raising capital, we're deploying capital, and we're investing in the digital economy.
And I will get back to, you mentioned the renewables, I'll get back to the ESG aspect, but also, when you think about data centers, it's being kind of like the physical house, for the internet, and it's storing that cloud and AI computing. And a lot of it is very complex, as you know. So the AI computing, rather like OpenAI's ChatGPT, it requires a lot of power for power and cooling. So how do you kind of get at the forefront of that infrastructure?
So it's for us, it's been, a decade in planning, to be honest. And so today, across our 188 data centers around the world, we operate in Asia, we operate in Europe, we have a huge presence in Brazil, and we have a large presence here, obviously, in North America. Today, we've got about 1.6 gigawatts of power flowing through those 188 locations. Our total power that we've designed for is 7.2 gigawatts. So the magic of what we're going through right now is how do we lease into that capacity? How do we go from 1.6 gigawatts all the way into 7,200 megawatts of power? And so we've been building that. We've been designing it, and we've been getting ready for what we think is sort of a, for lack of a better word, a data tsunami. And so we do have the most available power inventory, bigger than Equinix, bigger than Digital Realty, bigger than certainly any of the private equity sponsors that we compete against. We know this is a decade-long generational build. And so we took a risk 3 years ago of finding some of the best locations in Europe and in North America and Asia. But further to that, this business isn't about finding great real estate locations. I know there's a lot of real estate professionals in the room. Certainly we go get land, we get the entitlements, we get building permits. But the magic of what we do is we get something called a will serve letter from a utility company. Or we go build renewable energy adjacent to our digital infrastructure, or we enter into a long-term PPA with the renewable power. We're bringing that power to our data center and then passing it through to the customer. So again, none of this is accidental. We've been designing it for a long time. And to be honest, we don't think that 7.2 gigawatts is enough. We got to keep going. So we are investing in new locations. And as you alluded to, we're investing a lot in renewable power. That's really important to us.
And speaking broadly, when you look at the macroeconomic climate today, data centers, it's strong growth, but it sets it apart from what we're seeing in the broader commercial real estate market at the moment, which are struggling with higher interest rates, flagging demand. So how does the macro factors, how are they playing into your forecast for demand? Is this something that you're concerned about in your outlook?
Yeah, look, we're certainly concerned about it, but again, we're planning and we're prepared. So we made a decision 2 years ago across the 6 different data center businesses we own globally to term out all of our debt. And so I made that decision in 2020 and 21, and we laddered our securitizations in 5, 7, and 10 years. So today, 83% of our debt is fixed at a cost of about 3.8% with a weighted average maturity of 7.2 years. So we think we got ahead of it. Certainly we're not out of the woods, but again, just being ahead of it and planning and being at the forefront of these decisions is important. I've been a CEO for 25 years. I had the privilege of navigating through the dot-com crash. I navigated through the financial crisis, and I made mistakes, made a lot of mistakes in that environment, but we managed to get through those things by being ahead of it and having strong liquidity and making sure that we always had fixed term debt. And so when markets turn, you got to be ahead of that. And so at DigitalBridge, we made that decision. And I think investors are acknowledging that, which is why we're performing well.
And Marc, debt is one side of the coin, as you've mentioned, and fixing that debt and getting ahead of it. But what about demand? And do you see that slowing down ahead?
So here's the interesting part about demand in terms of, at least in our world, demand is up year over year, 25% in data centers across that segment. So there's 4 big segments that we operate in. We operate in the data center infrastructure space. We also operate in the broadband infrastructure space, which is fiber networks. And then we have cell towers, and then we have small cell infrastructure, Wi-Fi, private 5G networks. These are the sort of 4 principal food groups of digital infrastructure. And look, data centers, it's been great. It was up 25% year over year, but then again, the entire ecosystem is up because as you build more cloud infrastructure, you also have to build more fiber, you have to build more cell towers, and you have to build more small cell infrastructure so these things work indoors. And so small cells were up 6%. Towers were up 14% year over year, which is great for us. And then fiber was up 5 to 6% this year. So this is literally the first time, I think, in almost probably 2 decades where I've seen all of the verticals that we participate in, the organic growth has been up year over year. Now, does that stall? You've seen the earnings outlook for some of the cloud players. You've seen the mobile operators cutting CapEx by 20, 30%. Certainly, we can't keep up this velocity. Having been someone that built mobile networks in the 90s and having built public cloud, these things do have an ebb and flow in terms of how CapEx is spent. So we are tempering our expectations for next year. But remember, in our world, tempered expectations is instead of us growing EBITDA 25%, we're growing EBITDA 15% or 18%. That's a tempered year for us.
And Marc, as you look ahead, when do you see this AI demand really translating into the cash flows? I mean, you mentioned, about AI, whether it was overhyped or not. I mean, your stock is up some 40% year to date, but if you look at something like Nvidia, it's up 200%. So, getting your broader outlook on that.
Yeah, and look, NVIDIA has been a great customer of ours. We've been working with them for 5 years, and we're a principal provider to them for data center space and for fiber. The GPU space is radically transformed. And I don't know if you caught this, but a couple weeks ago, we led the financing on CoreWeave. We did a multi-billion-dollar credit facility for them. We stayed out of the equity, but our credit strategy played in that because we didn't totally believe in the equity story at that valuation. We love the equity story of CoreWeave, but ultimately giving CoreWeave, billions of dollars to continue to grow their network, it really demonstrates the shortage in chips, in GPUs. And, as much as we struggle with power, we continue to struggle with GPUs. And CoreWeave's an incredible example of how to be innovative and think around the corners in terms of how to play AI. That's not an overhyped idea, CoreWeave, right? Because it's ultimately providing that GPU infrastructure, or it's a SaaS model, really. It's SaaS as GPUs as SaaS. And that's kind of an interesting example of how you can play AI without having to be directly exposed to, writing an application or being in the source code business. So there's a lot of different ways to think about AI. There's a lot of different ways to invest in it. And that's how we're spending our time. We're thinking about ecosystem. We talk a lot about ecosystem investing, and we're not in the SaaS space. We're not in the software space or application space, but certainly we're a provider of infrastructure to that entire ecosystem. So it's pretty exciting. And I think, again, bring it back to where are we going? Where are we going today? These are language models that have pretty rudimentary use cases. But I think as we move into inference, you start seeing how AI will impact the enterprise. Mm-hmm. And I think that's pretty exciting because it'll impact everyone that goes to work in this room today will be impacted by AI in a positive way, I think in a very constructive way. And so we think the enterprise gets impacted in 2 to 3 years. And that's where you're going to see Microsoft ultimately take Azure in that direction. You're going to certainly see Oracle take their products in that direction. And there's going to be huge efficiency in terms of back office, workflows, and how we conduct business. There's a third phase to this, which I think is really interesting, which is more the science fiction phase, but we're close. We're 5 to 6 years away from that, which is ultimately, how does this impact machine-to-machine learning? How does this impact ultimately autonomous vehicles? Autonomous drones, early detection systems for homeland security. How does it impact how we run an airport, how we run a shipping port? These are real industrial use cases. And ultimately, that is the essence of generative AI. That's the promise of generative AI. And look, we've got a lot more infrastructure to build to get there, because when you're in an industrial use case and you're taking AI into machine-to-machine learning, it ultimately has to be as fast as the human brain. It has to make decisions very quickly. And that decision-making ultimately has to be less than 1/10 of a millisecond. Now, certainly a GPU can do that in a controlled environment, which is a data center that's sitting in Des Moines or is sitting in Quebec or is sitting in Iceland. But ultimately, that compute has to travel and it has to ultimately hit the device, right? And so it has to hit the car, or it has to hit the drone, or it has to hit the crane at the shipping port, and it has to make that decision like this. The only way it does that is if you start moving that compute, which is the processing, to the edge. And the edge of the network is ultimately next to the enterprise or next to that airport or next to that Tesla factory, wherever that use case may be. And then you need that fiber and you need those antennas to proliferate the signal. So as I said, I always throw a lot of caution in these discussions because we're very early. We're very early in this adaptation.
And I want to pick up there on the caution. You talked about the promise of it when we're looking at, digitalizing industries. But what about some of those challenges? And I said I'd get back to the ESG outlook here, the massive power consumption that is needed for the AI edge. And how are you adapting to that? And what do you make of these ESG complications?
Well, I think it's an opportunity. I don't view it as a complication. We started 4 years ago on our commitment to net zero 2030 at DigitalBridge. We own 29 companies. We manage assets all around the globe. We're about halfway through that journey. That was the easy part. I think getting to 50% carbon neutral across all of our assets was the easy journey. The next 50% is going to be harder. I see the light at the end of the tunnel. We made a big investment last December in a business called Switch. Switch is the largest provider of private cloud solutions, but we didn't buy Switch because it was the leader in private cloud, which we think is a huge opportunity. We bought Switch because it was 100% renewable energy to the data center. It's the only data center operator in the world that operates directly into green energy. And so when we saw the way they designed the data center, we saw ultimately the locations in terms of being next to hydro, being next to wind, being next to solar in a place like Reno, Nevada, where we share a solar farm with Tesla. This is next level thinking. And ultimately, our grid, as you know, is running out of power. We have great generation capabilities in the United States. We have horrible transmission infrastructure. Why? It was built 60 years ago. It wasn't built for cloud computing. It wasn't built for artificial intelligence. It was built by design and engineering standards in the 50s and 60s. And so as you see in places like, Northern California, Pacific Gas and Electric is out of power. There's no more power in Silicon Valley for data centers. There won't be any more power until 2028. You go to Data Center Alley, which is Northern Virginia. There was a lot of articles out last year about how Dominion ran out of power. Well, they didn't run out of power. They just didn't plan the transmission infrastructure where there was going to be 8 gigawatts of power within 10, sort of radius miles where all the data centers are. So the industry is waking up to the fact that within 8 to 9 gigawatts of power here in the US, we run out of power. Mm-hmm. And AI takes 35 to 38 gigawatts to get to where we need to get to. So there is this sort of artificial runway that the industry is staring at, and we have to come up with solutions. We think ultimately the best solution is putting renewable energy adjacent to data centers. And as we like to say, we want to build that renewable power behind the meter. We got to get behind the meter and bring that power directly to Microsoft, to Amazon, to Oracle, and help them solve their net zero problems as well.
And Mark, looking broadly at your business and kind of talking about delivering value to shareholders, I mean, the activist investor Legion Partners, he's been building a position in DigitalBridge and has been adding to that. And he's been so supportive of your leadership. And he said, I think that the company expects it to triple in value over the next 2 years as it's continuing to raise funds, as you mentioned, with all this, the AI and all the investments. But they also said about perhaps considering a sale if that shareholder value wasn't delivered. I just wonder in general what your take was on that.
Yeah, look, Legion is one of our biggest shareholders, and the two partners there are friends, and we have an active dialogue every quarter. I don't believe in activism as a concept. I think, the way I think about it is constructivism. And so the best way to turn a difficult conversation into a partnership is you enter into that conversation with an open ear and being constructive. I think all of our shareholders understand, when I took over the company 4 years ago, that I was going to change the narrative around our group, and we've done that. And we've done that by first and foremost, you have to be transparent in the way you do business. And so being transparent with shareholders, being transparent with our private LPs who give us capital to invest, this is the way I built my career. And so when Legion came to us and they said, look, we want to help you, we embraced that, right? We weren't abrasive, we embraced. And so that journey was working with them, looking at different ways that we can improve our governance, improve our board of directors, and they've been incredibly helpful. And so we turned a negative into a positive, which I think is always the way I look at life. And it's the same way we're tackling renewable energy. We're taking a negative and we're turning it into a positive. And so by having an active dialogue with our shareholders and being transparent, and it doesn't hurt to beat your guidance sort of 7 quarters in a row, we're doing that. We have a big saying to our shareholders, which is promises made, promises kept. And so that's what we're going to keep doing. We're going to keep exceeding our guidance. We're growing assets under management at the trajectory of about 20 billion a year. Half of that's greenfield construction that's aimed at the cloud and artificial intelligence, and the rest of it's brownfield. And in addition to that, we've also found out that we're pretty good at credit as well. So we had the good fortune of taking 2 of the original founders of Blackstone's credit team. We brought them in-house 3 years ago. We built a credit strategy. And as you know, private credit is on fire right now. So we just invested through our first strategy. We're working on our second strategy. And we keep adapting and we keep growing. And I think part of that growth is having a great relationship with shareholders.
And Mark, getting back to, as CEO of a global company, your perspective from the forefront, I want to know if you're bullish or bearish on any parts of the digital infra universe. Of course, you're in data centers, fiber, or any geographies as well, given that you're global.
Well, look, I think we said it on the last quarterly call. We're really optimistic about Asia. It's interesting because from an innovation perspective, most of us think of Asia and we think it's ahead because of consumer electronics and technology. And yes, that part of the world is incredibly forward thinking in terms of consumer-based infrastructure and consumer-based technology. It's a lagging economy in what we do. So in terms of total amount of cloud compute, fiber networks, cell towers, they're actually behind Europe, US and Canada being first, Europe being second, and really Asia being a laggard economy. So we see things in Asia that we saw in Europe 5 years ago and that we saw in the US 10 years ago. So it's a big investable opportunity for us. We deployed roughly about $4 billion of capital in our last fund into Asia. We made 4 investments. We just announced the closing of our new strategy, our third flagship fund. We've already allocated 25% of that fund to Asia. And what do we like about Asia? It's really simple. Lower inflation, the presence of an institutional debt market, which is non-existent in Europe and barely existent in the US today, highly educated workforce, wages are not growing as fast, and that's part of that inflation being in check. And then we have great customers that own infrastructure that want to sell that infrastructure to us and let us manage it for them. And so there's a lot of really positive tailwinds that are happening in Asia that we don't see in places like Europe and other parts of developed economies. We are a little negative on Europe. We've been pretty thoughtful about that. And look, Europe is going through a tough time. It has rampant inflation, high interest rates. The ECB isn't done yet. Private credit, really bank credit isn't there for corporations. And you've got Germany, the UK, and potentially France going into recession. So the 3 of the biggest economies there are really struggling. We see the road out for Europe as probably a 5 to 6 year journey. And then we are very bullish on the US. We think this is the best place to do business. In our new strategy, we're deploying 40 to 50% of our capital here in our home market. A lot of investable opportunities here, not just in data centers and fiber and towers, but we like digital media infrastructure. We like LEO satellites. There's other verticals that we're attacking, private cloud, by example, private 5G networks. There's a lot of optimism for the digital economy here in the US, and we're investing in it. Again, putting in that plumbing early and being a part of the cycle.
Well, on that note, Mark, I think we are just running out of time now, but I feel we could have talked for, a whole lot longer. There's so much to discuss there. So I want to give another big thanks to you, Marc Ganzi there, the CEO of DigitalBridge.